I'm Douglas Mason, President and CEO of Rainy Mountain Royalty Corp., RMO on the TSX Venture Exchange. Rainy Mountain's Brunswick property is located in the Rideout Shear Zone in Ontario. With grab samples running as high as 32 grams per ton gold, a drill program will commence this spring to test the numerous targets located by recent groundwork. For more information, visit our website, rmroyalty.com.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is market historian Bob Hoye. He's the chief investment strategist for institutionaladvisors.com. Happy Canada Day. Happy 150th birthday, Canada.
Yeah, we're having that event, and also next week would be the American Independence Day. And gosh, I guess with the reform that's being put forward by the popular uprising, the U.S. may become a little more independent. But in the meantime, in Canada, our always caring federal government is expanding its tentacles everywhere. So, fascinating world we live in.
Donald Trump has declared he wants to make the U.S. a dominant energy supplier. What does that mean to Canada?
Well, Canada would have no choice but to loosen up as well, which there is a touch of common sense appearing in Canada. You've had this curious situation whereby pipelines were not allowed through British Columbia because it would involve more oil tankers on the pristine waters of the Pacific Ocean, whereas back east, no pipelines were allowed because they want to keep oil being delivered to the East Coast by tankers on the pristine waters of the Atlantic Ocean. So it's a very curious situation. But I think that can crack. There's no reason why energy from the West should not be shipped to central Canada, and that would then displace shipments from, dictatorships like Venezuela and Nigeria, wherever, So anyways, there is a ray of sunshine possible in Canada regarding petroleum energies. And then in the United States, it's not that Trump will make U.S. a powerhouse in international oil production. It's that the political forces are changing that would allow that. So you have a continent that's rich with energy reserves by way of coal, natural gas, and now crude oil. So, and the American initiative has been changing the whole of the energy world from decades ago when OPEC, which was a form of a cartel, thought that they were running things, to where in the last year they have attempted to get back into running things by promising amongst themselves to cut back on production, like in the Middle East and various places like that. And so this is a bureaucratic insanity because they cut back in production to get a higher price. But if you're selling less of it, you're not making any money. You're just trying. What it is they're trying to jam the markets, and crude oil prices will do what they will do. And a few weeks ago, I guess more than a few weeks ago, crude had rallied out at the year end and up to 55, and the sector became a little overbought. And on the chart, the obvious resistance was at the 42 level, meaning somewhere between 42 and 43, and as it turned out, the low was 42.05, and we've had a nice bounce, but perhaps that's about as far as it's going to go. on going the other way on this is that the U.S. dollar index, which has been in decline since the first of the year, I think the political problems, or the rest of the world is seeing political problems in the U.S. and potential constitutional problems, but that's probably all in the markets now. And so let's put it this way, and we've been saying it for weeks, that the U.S. dollar, once it bottoms, would be followed by a pretty good rally. We had thought that the 96.5 level would be both a target and resistance, which it was briefly, but when it got to there, we had our downside capitulation on it, which is usually a pretty reliable indicator, and as well as a sequential buy, and it did lift off to about 97.5, but then back down the moment it got below 96. It's drifting a little lower. So I think that the technical excesses are there, but it just needed to get a little lower before it can really do the bottom. And also what's going on here is we're getting distinctive changes in the U.S. credit markets, where we've had terrific rallies in junk bonds, which to a few weeks ago became excessive, and they've started a setback. And then you've also had, with that, a terrific narrowing of credit spreads, which shows a growing confidence in the financial markets. And that ran until about 4 or 5 weeks ago, and did accomplish some excesses on its own, and is working to turn to spread widening, and much similar, we think, to in May and June of 2007, which then went into the worst credit collapse since the 1930s. So we're watching this closely. So we've getting the turn in spreads to widening, which is not good. And the other part is the curve, which is the difference between long-dated and short-dated bonds. It's been what they call flattening, which typically is part of the party. Now, some researchers think that the curve really has to go to inverted, where short rates become higher than long rates. But we've got a chart on the U.S. yield, the U.S. credit yield curve going way back, I think the 1850s. And while it is clear that when you've got an inverted curve that shows quite a bit of speculation, you don't really need to have the curve go fully inverted. All it needs to get close and then reverse, and that then marks a change in the credit spreads, in the credit markets. And what happens with the change is that there are many players in the credit markets who have always, as confidence grows, becomes more aggressive in positioning, and they're positioned for party time. And when you get the change in spreads and in the curve, that says the party is over, and you can find people who are offside suddenly. Like, for example, in early June of 2007, that was just early into the change in the curve and spreads, and suddenly Bear Stearns announced that some of their highly leveraged funds that they managed were offside and money had disappeared. So that was step one. So the main thing is to understand that when the credit markets start to change, there are many positioned aggressively who are not prepared for change, and then suddenly they're offside. So if the yield curve continues to work on a change, then that's the other side of the equation that we've been looking for, and one should be quite wary about this. We've also already said that one should be out of all kinds of low-grade stuff, high-yield, low-grade bonds, preferred shares, all that sort of stuff. It's tough to take a lower yield, but then it's better to do that than take a huge hit in price with some of these things, which can become quite illiquid.
We'll have more with Bob Hoye right after the break.
Lotus Ventures Inc. is a BC-based medical marijuana company poised to launch into the rapidly evolving cannabis sector. Lotus is in the final review stage of the Health Canada approvals to become a licensed producer, having arranged facility financing of up to $12 million, plus building permits for its prototype indoor production facility. Shares trade under the symbol J on the Canadian Securities Exchange. Visit our website at lotusventures.ca.
Avon Resources Limited is a gold exploration company with significant projects in British Columbia, Saskatchewan, and the Yukon. Trading on the TSX Venture Exchange, symbol ABN, and the pink symbol ABN-AF. Surrounded by world-class gold deposits and mines, Avon's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at avonresources.com.
Welcome back. We're speaking with Bob Hoye. Bob, something I've noticed over the year, copper is at $2.71. At the start of the year, it was barely over $2. Why is copper been increasing in value?
Well, you had, oftentimes, copper can be depressed down into November, December, and then does a seasonal recovery, which has been this case. Some of the other base metals have been doing okay as well. And then more recently you've had the slide in the U.S. dollar down to a lower level, all of which, all of these major commodities are priced around the world in U.S. dollar terms. So that, to me, explains that copper has continued up, but it's changed hugely from when it was $4 a number of years ago, and you had headline stories often about some guy electrocuting himself trying to steal copper before they turned the juice off. So, but you're not seeing any stories like that, because you did have copper get down to way below $2. And so recovering first on the seasonal and second with the U.S. dollar weakening. And if the U.S. dollar weakening is working towards another base, and we think that if there's a high probability that there'll be financial distress discovered in the fall, the old pattern has been that on great financial bubbles, which we have been in yet another one, a record going way back to 1720 is that the highs in Europe and London will likely be in May or June. And then since 1873 bubble, when then the U.S. market became more important, but not the key market, then it was London. But at any rate, the tendency is that when you've had that peak in May or June for London and European stock exchanges, the U.S. market can get up on its own and set a high in September, very fateful September of 1873. And at that time, a leading newspaper in New York editorialized that nothing could go wrong. And the reason why nothing could go wrong is because the U.S. did not have a central bank on a gold standard. It had what they call the Treasury system, or the national banking system, whereby the power was in the hands of the Secretary of the Treasury, and not being on gold, he had then the ability to expand credit infinitely. So that's what the basis of that editorial was, that the Treasury system was way superior to a mere central bank, and nothing could go wrong. Well, it was one of the worst collapses in a generation, and it went into what was in England called the Great Depression that lasted till 1895. So then we move ahead to the bubble that peaked in 1929, when then John Moody of Moody's wrote a piece saying effectively that nothing could go wrong. And the reason why nothing could go wrong was because they had a new and scientific Federal Reserve System, and they had got rid of the old, nasty Treasury system, which had been such a problem for so long. So then, of course, you went into the 1929 crash and contraction, and then moving ahead to 2007, and as it was peaking, it had a number of the signposts of a classic bubble completion. And, it turned out to be quite a crack. But in December of that fateful year, Greg Mankiw, a Harvard economist with a great deal of prestige, he looked at the threat developing and said, in so many words, that nothing can go wrong. And the reason why was because they had a dream, his terms, dream team of economists at the Federal Reserve. So, hey, nothing could go wrong. And then in the establishment's own words, a year and a half later, they decided that it was the worst collapse since the 1930s. So, and here we are. This is the first business expansion out of that crash that ended in 2009, and the first bull market out of that. And the bull market is showing all the signs of a peak, with sentiment figures and technical numbers unseen since some of the series we watch are at levels not seen since the crazy bubble of 2000 and that tech.com bubble. So markets are very volatile, and on the base metals, they would be expected to roll over in anticipation of credit distress. Would expect now. One of the things that is happening is that gold and silver have not been rallying too strong, and as a matter of fact, they've been quite disappointing. But what we're watching for in silver is that gold and silver can maybe trade in a range over the next 4 or 5 weeks, but at some point, if there's a trading day and silver is down a bunch compared to gold, then that's a warning on the developing credit crisis. The gold-silver ratio really is a metallic credit spread, and in party times, the ratio goes down as silver outperforms gold. And then going into credit problems, the gold-silver ratio goes up. So it's actually a very good indicator. While it's frustrating for gold and silver bulls lately, for those who understand how the ratio works, it's telling a story.
We'll have a couple of listener questions when we return with Bob Hoye.
I'm Larry Ray, President and CEO of American Manganese, Inc., listed on the TSX Venture, ticker symbol AMY, A-M-Y, with proprietary patents in the U.S., China, and South Africa. Our focus is on recycling lithium-ion batteries for electric vehicles. China recently legislated the responsibility for recycling onto their electric vehicle manufacturers and importers. For more information, please visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Keep informed. Receive our weekly recap of thought-provoking articles, podcasts, and radio delivered to your inbox for free. Sign up for the HowStreet.com weekly recap on our homepage, HowStreet.com. Welcome back. We're talking with Bob Hoye. Bob, we have a question from the Netherlands. Bob has been bullish on the U.S. dollar for a long time, and for good reason. However, the dollar index now broke important horizontal support at 96.5. Given momentum and pattern, that support actually should have held. His question, what has happened and how important is this? By the way, the question is from Bert in the Netherlands.
It broke below support at 96.5. I think could be a compounding feature of the political storm going on in Washington, which the opposition side to the presidency is getting absolutely bizarre, and other things just going on that the moment the European economy is looking good or better. So whatever, you can always find a reason after the event why it slipped to a new level. But we think that the technical indications, the technical excesses generated on the way down are, of course, still there, and maybe even a little more so. So it is going to still have to build a base for a number of weeks before the next rally would take off, and we would think that credit distress developing after August would strengthen the dollar. In previous contractions, the U.S. dollar has gone up. I think just the way the markets work. So, good question, Bert, and look forward to more from you.
And we have a question from Frank in Belgium. He says, "Hi, Bob. Is this coming post-bubble contraction going to be your standard 2-year downturn and correction, or is this going to morph into the mother of all deflations that actually clears all the absurd excess and corruption that makes me so sick?"
That's a good one. Yeah, to both. Financial storms are interesting, and since the public record, at least on the great bubbles since the first in 1720, where I said a little while ago they had a tendency to peak in May or June in Europe and London, and then dither around in the summer, but all of them, repeat all, crashed in the fall of the year with heavy liquidation late September into October, and then kind of a pause, and then another test of the markets in November, which was just sort of like a bit of a relief rally, and then, it's happening again, and that test holds, and then you're finished on that terrible financial storm. In one bubble in 1825, the final clearing didn't occur until December, but hey, that's the pattern is crash in the fall. So and relief into the new year, and then it would be part of a bear market. And how long do they last? Maybe 18 months, 2 years. But this would be part of a long contraction because you've had the central bankers have gone absolutely mad in imposing arbitrary notions upon the financial markets. And the bond bubble has been the biggest in history. And you can look at previous post-bubble contractions essentially as a period when all of the excesses done in the party times are eventually cleared and worked out, and it takes a long time. Each of the long post-bubble contractions have lasted about 20 years. But you still had the usual 3 to 4 year business cycle. And that's why, like in 1938, people suddenly saw that expansion rolling over, and they called it a depression within the depression. So, yeah. So to this question, it would be, yes, a 2-year bear market, but it would be part of a very important unwinding of all of the intrusions and all of the excesses in the marketplace and in private life. And I've been calling it a potential great reformation. The last one followed the early 1600s, where then about 120-year period of massive intrusion by governments in Europe and England. That would be government plus church. And the public knew it wasn't right. The intrusion was immense, and they eventually threw it off. Now, that one in Germany, you had the 30 Years' War, which was dreadful, and you had a civil war, a brief one in England, which was also dreadful. But generally, England worked its way towards Reformation much better than did the population in Northern Europe. So I think a huge, great Reformation is possible, whereby the intrusion by out-of-control governments comes to an end. It's going to take a long time.
Well, I have to ask you, what about Janet Yellen's declaration that it's unlikely we'll have a major financial crisis in our lifetime.
Yes, I did make a note of that one. I think that's a pretty good one. That may be up there with Greg Mancu's statement in December of 2007 that nothing could go wrong. So, but
Bob?
Thanks for that one.
Yeah. I was going to say, you answered her statement, I would say, throughout this entire broadcast.
Well, it's nice to formalize it, so.
Bob, have a great Canada Day.
You too, and the weather forecast looks good for our neck of the woods over the weekend.
My guest has been market historian Bob Hoye. He's the chief investment strategist for Institutional Advisors. You're listening to HowStreet.com radio. Find us on Twitter at TalkDigitalNet. Our YouTube channel is Talk Digital Network. Questions for the show or for Bob can be sent to info@HowStreet.com. I'm Jim Goddard. Happy Canada Day.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.